What's up guys, welcome back to another episode of Mind Something. If you're new here, my name is Jake, and in today's video, AMD might have to recall all of their 7000 series GPUs. And we've got some news for Flux we need to cover. Also, central banks are buying BTC and other cryptos. We're going to talk about that. And then lastly, AMD and Nvidia are price fixing the market. Could they potentially be in trouble by the FTC? So without further ado, Happy New Year to you all. Let's get in and take a look at the market right now. Bitcoin is coming in at $16,669. Ethereum is just over 1,200. XRP is coming in at 32 cents. Dogecoin at under 7 cents. Cardano at 24.99 cents. Polygon Matic at 75 cents. Litecoin at $70. Polkadot at 445. Solana is at $10. And Toncoin is at $2.26. Let's go ahead and take a look at some of the GPU mineable coins. We'll start with Kaspa. So Kaspa is down about 2% after a nice little pump. If you've been watching the channel, you know we talked about hitting that area of support, and it looks like we did get a pretty nice bounce off of that. Now this comes off of the news with Dagnite being fully funded for development, and it's weird how news and charts line up, isn't it? Anyways, next one we got is Radiant. Radiant is down almost 10% again at 0.00077. And let's see what else we got. Let's take a look at Neoxa. Neoxa is down about 3.5%, and Flux has been pumping. It got up to over 50 cents today, almost 52 cents earlier. We're currently sitting at about 7% gains over the last 24 hours. Let's go ahead and take a look at the year chart here. As you can see, this pump is pretty insignificant compared to what's happened throughout the whole year. But we'll get into why Flux is currently pumping, or at least why I think it is. Next, let's go ahead and take a look at a 3070 on what to mine at 10 cents per kilowatt hour. Radiant is coming in at negative 8 cents, Kaspa negative 11 cents, Ergo negative 12 cents, Flux negative 14 cents, ETHW negative 17 cents, Vero negative 18 cents. And yeah, unless you've got 7 cent per kilowatt hour prices or better, you are probably mining at a loss if you are mining at all. Let's go ahead and take a look at the chart here for Nexa real quick. It did have a little bit of a recovery over the last 48 hours. It's currently sitting at 0.0000157. Within the last 24 hours, we got up to 167. And if we just kind of zoom out on this chart here a little bit, you could see we could potentially be putting in kind of a cup and handle formation here, and I would say we're sitting right at this level of support. It'll be interesting to see if it drops down lower or if we continue to go up from here. Now in a bear market, you would expect just putting in lower highs and lower lows, but it's such a new coin, it's really hard to tell what it's going to do. Anyways, the next thing I wanted to talk to you guys about was a big problem that AMD is facing with their GPU temperatures, and it looks like we have confirmation on what the problem is, and unfortunately it may require a recall from AMD. So let's take a listen here to what he's saying is the problem.
Sure that it's the vapor chamber itself. There is no other thing left. It's also not the surface quality of the vapor chamber or anything. Everything else is eliminated. It is the vapor chamber. It's only this. This means that the entire thing is so much more of a problem than I expected, and honestly AMD is going to be in trouble, like big trouble. Because if you just think back with the Nvidia 12 volt high power connector, when we did the first videos, I didn't even do videos, but other YouTubers did videos, and they were desperately trying to find somebody that had a problem. So it was like a few out of 100,000. And here we have thousands. We have thousands of people who have this issue, which is insane. And I'm not quite sure what the correct move would be, because waiting for the customers to do an RMA when there is like a possible design failure in the vapor chamber itself, it's probably not the right choice, and I guess they will have to recall the entire MBA cooler series.
Wow, so it looks like AMD shouldn't have been pointing fingers at Nvidia for their faulty 18 pin or 16 pin connectors. It'll be interesting to see what AMD does from here, considering how many of their GPUs are affected with this particular vapor chamber issue. But I don't know. As far as speculating whether or not they're going to issue a recall, I can't even begin to fathom what type of loss they would be taking for the logistics of shipping all of the products to and from their facilities, let alone performing the repair on them. And then you also have to consider whether or not it's a design flaw in the hardware or if it's something that can be addressed. I mean, we may be talking about the component itself needing to be completely replaced. It could simply be an element inside of it, but I don't know. But it's not looking good and very unfortunate. It looks like they rushed this particular product out, trying to get in there just in the nick of time right after Nvidia had launched the 4090. So just stay tuned. I'll keep you guys updated on that. Next, I wanted to get into some news around Flux. So you can see this on their Discord. In the upcoming weeks, Flux OS will have its major update to version 3.31.0. This release is big and includes new app specifications. Version 6 giving you an option to subscribe for an application for up to a year period. On top of that, we bring several more major functionality such as soft forks, enhanced app compliance, test launch of apps, improvements to app networks, multiple volumes, peers and communication improvement. So I'm going to go ahead and click on this and we can read a little bit more here. So Flux app specification version 6. Expire version 6 brings new parameter of expire, determining how many blocks application can live on the network, from 5,000 blocks till 264,000 blocks, 1 week to 1 year. This parameter can adjust on a 1,000 block interval. Default supported options by Home UI are 1 week, 2 week, 1 month, 3 months, 6 months, and 1 year. Flux Foundation application addresses changes from single signature to 3 of 5 multi-signature address consisting of the following core team key holders, which would be Daniel Keller, Parker, Tadeus, Jeremy, and Walter. This adds additional trust and security to Flux OS. Ability of soft forks. Foundation multi-sig address can initiate soft forks of Flux OS by sending proper transactions to itself with soft fork specifications included in the message field. Current soft fork supported is application price adjustments with more potential flags to come. Soft forks activate immediately on the following block on which transactions was mined. This introduces new database chain params. Application prices can now be adjusted on the fly with soft forks. Blacklist was extended to also support blacklist of Zel ID and application hash. I'll just let you guys read this for yourself. I'm going to link it down in the description below if you want to check out the rest of it. And continuing on with Flux here for just a moment. So these are some big developments for Flux, which is excellent. By the way, we do have a halving coming up in February, in case you had forgotten. You know, as far as halvings on every coin other than Bitcoin, it doesn't really seem to make a difference as far as price of the coin is concerned. Now, it does reduce emissions, so that has some effect on it, but not like the Bitcoin halving, right? And I love to see this happening on Flux. I believe very strongly in the project. But I did want to point out just a couple of things here. So one thing that I noticed from the developer of LOL Miner, there was a discussion around ASICs and Flux. And just want to read this particular paragraph to you real quickly. Well, I just wanted to put something into that right light. And I need to know it because I did implement the Flux proof of work verifiers in the Flux node and also did write its reference miner. So I know what I am talking about. So, well, what I wanted to say is I would disagree with the term ASIC resistant in general somehow because one can almost do an ASIC for every algorithm and it would be easy doing one for Flux that is like 2 to 3 times faster than GPUs while consuming half the energy. That said, there are OFC algorithms that are more suited for ASICs. On Caspa, the advantage of ASICs would be way higher, and some of which the advantage would be less. Therefore, in my opinion, speaking about its resistance is too much black and white for me because there are a magnitude of grayscales in between. Saying this is ASIC resistant is just marketing talk. Saying it is not as ASIC friendly as XYZ is a way more accurate statement. And that's interesting, especially coming from the developer of LOL. So, just a reminder to you guys, when somebody is promoting something as ASIC resistant, it's kind of like when you're talking about cell phones being water resistant or waterproof. There's a big difference. Water resistant means it's not very easy. Waterproof means it's not happening. And, I guess maybe the term resistance is a bit strong according to the developer of LOL Miner. But just a reminder, these things are possible and something to keep in mind. Also, I noticed something that Daniel Keller tweeted out today, and I wanted to have a discussion about this. Now, you know my thoughts and feelings around Flux, and you perhaps have heard me talk about Daniel Keller before. And I think the guy is extremely vibrant. He's got a lot of energy, and for the most part, I agree with just about everything that he says. However, we have to be careful when a project has a lead person involved. I think it can be a net positive, but also a net negative depending on that particular leader's, you know, what he says publicly. And Daniel Keller is very, very, very vocal on Twitter. And something that he said today, I wanted to share with you guys. So he says, times are bad when YouTubers start shilling no cap shitcoins. Friends don't let friends mine shitcoins. And I'll read you my reply here in just a moment. But this was a very spot on reply. Can Devs Do Something said, Flux was once Zell and a no cap shitcoin that I mined at a loss. Why so hostile, sir? And Daniel replied that he's not hostile, but pointing people to scam or suspect projects in 2017 shit. So my reply was this. I'm not saying you're wrong, because I agree. We shouldn't point people to mine shitcoins. But shitcoins is a very subjective term. What I consider a shitcoin may not be considered a shitcoin to someone else. Obviously, the developer is not going to consider it a shitcoin. But what I told Daniel is you should really create an anonymous Twitter account to vent on. You're the face of Flux, and I worry Flux will succumb to criticism because of your lack of filter. And Daniel does not have a filter. And I'm fortunate enough that I can talk about this because the channel is small. If I'm being honest, prior to replying to his tweet, I was a bit nervous. This kind of puts myself in a corner here when it comes to potentially having an interview with Daniel at some point. I don't want him to think that I disagree with everything that he says or that I don't like him, because I do. I really do like Daniel. I think he's a net positive for Flux and for the space. However, when you look at Cardano right now, I would say Cardano is really suffering because of some of the things that Charles Hoskinson has said and done in the past. Initially, he was a huge net positive for the project. But if you look at some of the opinions and some of the things that's been shared on his YouTube channel, it doesn't always rub people the right way. And, if I'm being honest, initially when I saw this, he's saying that YouTubers are shilling no cap shitcoins. I hope you guys would agree, but I don't feel like I'm shilling any coin. I'm just simply covering the news and letting you guys know what I do. Now, that in my opinion is very different from, just promoting a project and telling you it's the greatest thing since sliced bread and you should definitely be mining this and all of the pros and cons of doing so. But I try to remain objective, but I did take a little bit of offense when he's saying that YouTubers are shilling no cap shit coins because, again, going back to what this person said, at some point that's where Flux was. And, how did he feel when people were calling that project a shitcoin? I just worry that his lack of a filter is eventually going to rub people raw. And Daniel, if you're listening to me, I know you read the tweet, but man, a lot of Flux's success depends on what you say. And I hope you take that to heart. I really do. Anyways, moving on. Let's talk about this article from Tom's Hardware. So AMD, Intel, and Nvidia reportedly slash orders with TSMC. Being the world's #1 foundry, TSMC was almost immune to the softening of high-tech market in Q2 and Q3, but it looks like the party is over even for the world's largest contract chip manufacturer. TSMC's leading customers began to revise their order to the company, affecting the foundry's results starting from the fourth quarter of 2022. Anyways, I'm not going to read this entire article, but just wanted to point out that, things aren't going to go that well for TSMC as well as the other manufacturers, and it'll be interesting to see how that plays out in the future. And then we've got this one also. I wanted to cover an article on Cointelegraph talking about the death of play-to-earn gaming. So, play-to-earn gaming enabled by blockchain technology has grown exponentially over the few years. Gamers have embraced the opportunity to collect cryptocurrencies or non-fungible tokens that have been produced in blockchain-based games. Though the advent of this new technology, players have been able to generate income by selling in-game NFTs or earning cryptocurrency rewards, both of which can be exchanged for fiat cash. Because of this, according to data from Absolute Reports, the estimated value of the GameFi industry will grow to $2.8 billion by 2028, with a compound annual growth rate of 20.4% over the same period. But such predictions may well prove to be unfounded. Given the rate of exponential growth over recent years, one might think that there was absolutely no reason to believe the trend would not continue well into 2023 and beyond, right? Wrong. As we have seen with the ignominious case of former crypto king Sam Bankman-Fried and the implosion of FTX, a castle built on flimsy foundation of sand can easily be washed away when the tide comes in and goes back out again. Or, as a legendary investor Warren Buffett liked to put it, only when the tide goes out do you discover who's been swimming naked. We may be about to learn who these people are. The fact of the matter is, the play-to-earn gaming industry is not built on foundries. The foundations are fragile and flimsy, and this could well spell trouble in 2023. The whole edifice looks set to come crashing down. The structure of the current GameFi market is token-centric, and this can create a number of issues. Project owners issue their tokens, which are listed on exchanges first before they announce that they are going to build games. Games are a utility of tokens they issued. Some tokens come first and contents later. This is why the quality of design of games in the blockchain space are so underrated. An environment has been created in which the players are not all that interested in games themselves, which is a strange state of affairs for gaming industry to find itself in. More and more of the players are in reality investors who want returns on investment. The current structure creates the wrong kind of incentives, and this is one of the reasons why the system is not working as it should. I would argue that DeFi Kingdoms, which is one of the better known play to earn blockchain games out there, has been screwing with its tokenomics relentlessly by creating perverse incentives. By now, generally speaking, the token market is in a downtrend and the speculative trading market is dead. An industry can survive for a certain amount of time on promise, except expectation, and unjustified hype, but it can only do so for so long. Eventually, people begin to notice that they haven't received what they have been promised. Patience starts to wear thin, they get angry, they get frustrated, and then they begin to withdraw. This begins a trickle of the savviest players, but that can soon become a flood. Those who have played to secure funds by listing their tokens will have to reassess. Many will be forced to close their projects due to insufficient funds. This situation is becoming so acute that even Hiro, Hit Hiro, Hit Hiroto, bullish crypto venture capitalist VCs are also pausing new investments. So, who is going to survive the investment drought? It looks unlikely that GameFi will. However, other blockchain gamings might do so. One example is the Ethereum powered NFT based fantasy football league operator Sorare has become a Web3 unicorn, while many of its competitors struggle. Sorare keeps on increasing its users and revenue during the darkest period. Their daily auction volume is impressive at around 300 to 400 Ether, and the number of users keeps increasing. Though its back end relies on blockchain, users do not perceive it as a GameFi project. They do not provide their native tokens, but they do provide their content first on Ethereum, which very much looks like the way to go for the industry at large. So GameFi may well die in 2023, but that does not mean that it all is lost. Death is a necessary part of evolution. From it, new life may already be beginning to emerge. So, as far as play to earn things that I have seen, I haven't spent a whole lot of time playing any of them, but I can tell you this from everything that I've seen visually, it looks terrible and it doesn't look appealing. And I agree. I think that a lot of these need to die for the evolution to continue. Now, what I will say looks interesting is something like Neoxa being layered into existing games that people are already interested in playing. And I think that that may be a better approach for now until the development of some of these other projects get good developers for the games themselves. I mean, in most cases, if it's not visually stunning, it's just not going to grab anyone's attention. So I think we need to start there, and if we can't get there, then we need to start with existing games. But I don't know, time will tell how this all plays out. So the next thing I want to talk to you guys about is a video that I watched from Coin Bureau talking about central banks buying Bitcoin. Now, I want to cover some of the highlights, but I do recommend that you watch the entire video, and I'll link it down in the description below. But essentially, what we're looking at is the BIS, which, if you're not familiar with the BIS, this is the Bank for International Settlements. The BIS's mission is to support central banks' pursuit of monetary and financial stability through international cooperation and to act as a bank for central banks. So Guy goes on to talk about something that's being put forth by the BIS, and what this consists of is basically a roadmap for central banks to hold cryptocurrency on their balance sheet. And they kind of categorize the different cryptos. So they have two different groups. There's group 1 and group 2. Group 1 consists of A and a B. And A is basically real world assets like stocks that are tied to a crypto. And then B is basically centralized stable coins. Okay, so you've got USDC, Tether, etc. Group 2 would be cryptocurrencies such as Bitcoin, Ethereum, Cardano, XRP, etc. And what they're saying is that banks will be allowed to hold 2% of their total holdings in group 2. Now, they can go beyond that, but it will require additional capital on their books. So in other words, you're kind of penalized if you want to hold more than 2%. Now the interesting thing is if banks or central banks were to allocate 2% of their total worth towards cryptocurrency, that is 3.6 trillion dollars if all of the banks allocated 2% on their balance sheet. And as you know, in the last bull run, we got up to a $3 trillion total crypto market cap. So imagine what the total market cap would be if all of the banks did allocate 2% towards this or more. I think we could see total market cap exceed 5 trillion pretty easily, because at that point, let's face it, everybody else is going to FOMO in as well. And a couple other key things to note here. So central banks can play favorites with certain smart contract cryptos. Now, this is going to be subject to local jurisdictions. So, for example, if the U.S. says that these are securities and these are commodities, that may affect what central banks can do as far as playing favorites. But in reality, governments typically go with whatever they're being lobbied to do. So really the lobbyists are the ones who are going to be controlling what cryptos that banks are going to hold on their balance sheet. And then the other thing is that they're not going to allow any decentralized stablecoin at all, especially if it's going to be an algorithmic stablecoin. That is clearly outlined because obviously that threatens the entire banking system. They want to see stablecoins that are backed with other fiat currencies. But it'd be really interesting to see how this plays out. And if you're curious when this is going to take effect, this goes live in 2025. How interesting is that? So this will probably be, at the peak or towards the end of the next bull run. So, are we going to see a massive bull run leading up to 2025? Or are we going to be on a downturn, or are we just going to go sideways all the way until 2025? It's hard to say, but I'd love to hear your comments down below if you have thoughts on the matter. So the last thing I want to cover with you guys is in regards to AMD and Nvidia price fixing. So there was a particular gentleman, I believe it's Cortex channel, that has a pretty lengthy video. This is about a 12-minute video, but I just wanted to take a couple of key points out of this. So this is from the Federal Trade Commission. It says price fixing is an arrangement, written, verbal, or inferred from conduct. That's a very important thing to keep in mind. Inferred from conduct among competitors to raise, lower, maintain, or stabilize prices or price levels. Generally, the antitrust laws require that each company establish prices and other competitive terms on its own, without agreeing with a competitor. In other words, you need to base your prices off of your own situation. So if it costs you $50 to create a product and you want your margins to be 50%, then you're going to charge $100 for that particular product. And it should be based off of that. It should not be based strictly off of your competition, because essentially if you're price matching your competition and you're not giving a true apples to apples comparison over your model's technology and your previous technology's cost and everything associated with it, then essentially what you're doing is you are manipulating the market, and that is against the law. Just keep that in mind. So I want to rewind and play something very specific. This is from, I believe, one of the main guys at AMD. So let's take a listen to what he has to say here.
On its own, without agreeing with a competitor. Here's Frank Azor from AMD talking about the 7900 XTX. Gordon Ung from PC World asked Frank on why AMD didn't show any comparisons to Nvidia when announcing the 7900s.
So Nvidia hasn't sent me a 4080 yet, so I'm kind of waiting for that to come in before I can have the comparisons. No, I mean, two things really. This card is designed to go up against the 4080, and we don't have benchmark numbers on the 4080 yet. I think we'll see those in a few weeks here. But now, realistically, is we don't know exactly how the 4080 is going to perform, but with how we are performing right now, we're confident and we're comfortable that we're going to make them sweat.
Well,
so basically what he's telling you is the price is not based off of what their cost is in the product, what the market is willing to pay for it, what the fair price, all of these different things that are specific to them. It's based off of Nvidia. It's based off of what Nvidia is going to charge. So if Nvidia decides to charge $5,000 for a 4080, what he's telling you is they're going to charge $4,750. Has nothing to do with how much it costs them to make the product, has nothing to do with market demand. It has everything to do with maintaining a certain price point with the competition, which is against the law. And I do hope that something is done about this. But, you know, how often are things done in our favor these days? Anyways, I hate to be pessimistic. I'd like to end on a positive note and tell you guys, so far the year is going pretty well for me. I had an excellent New Year's Eve celebration. I hope you guys did too. Do me a favor, leave a comment down below. If you haven't already liked, hit the like, and if you haven't subscribed, please consider doing so, and I'll see you guys tomorrow.